The year you were born in makes a much bigger impact on your long-term success in the stock market than you would think. So yeah, the truth is if you were born in certain years, you're going to have less success than someone else who was born at a different time. And I know that's hard to hear because a lot of us, especially those of us who are type A individuals, we think we control everything. So we think any success that we get was all up to us. That's the whole idea of being self-made, right? It's not luck, it's skill. Yeah, we always say things like that, but we discount the fact that we were lucky enough, for me example, I was lucky enough to be born in America. Because if I wasn't born here, I wouldn't have had the same success that I do now. Which is, again, that argument about being self-made, the self-made billionaire. Are they really self-made? No, they probably had a lot of advantages too. That's not knocking their success or anything. But you could say that they are partially a product of their environment, which no one likes to admit because it feels like it diminishes something that they did. So when we bring it back to the stock market, what do we think? If we invest the right way, then we are going to be just fine. Doesn't matter when we were born or anything like that. It's all up to us. Well, in reality, it's not so much up to you. This video will explain why you are a product of the time that you were born in, and you'll see that if you don't accept that and you don't learn the lesson that we're about to discuss here, you're going to be in big trouble in the future. And I'll tell you right now, it especially affects the younger people. I'd say 35 and below. Now, I was thinking about this idea because of the book that I'm reading right now. And that book is The Psychology of Money by Morgan Housel. Pretty popular book if you're on FinTwit anyway. But I like it so far. It's real good. And we're going to use some examples from that book when we're talking about this. But the whole idea here is that the time in which you were born has a huge effect on how you treat your finances and also the opportunities available to you. Now, this is something I'm sure you know because you've heard examples of this from people who were born during the Great Depression. Now, I know this makes sense if we think back to people who went through the Great Depression. So our grandparents or even our great-grandparents. What do we know about those people? They do not trust banks at all. And why don't they trust banks? Well, because there was a huge bank collapse, right? There was bank runs. They lost everything. A lot of people did. And based off that experience, you know that generation never trusted banks again. They would put their money under their mattress or they would keep it hidden around their house. They would never put it back into an institution. Where us today, we're like, no, that's crazy. Why wouldn't you put it in a bank? But again, because of what they went through, that directly affects how they operated going forward. And here's the thing. We all like to think that we are rational individuals, right? That we look at data and make decisions based off that when it comes to our personal finances and the stock market. But the truth is, no, that doesn't happen at all. Realistically, we all make decisions based off our emotions. And here's what's interesting. Memories and how you form them in your head, it's directly related to the emotion of that memory. So we're not like computers where we just store data. The only way we actually store a memory is because of the emotion. So the emotion that we feel during that time imprints it into our brain so we can actually remember it. There's no way to separate the two. So most people's financial future and their financial decisions end up being determined by what happens to them in their early life. And early life, I'm talking about when they have some money too. So like in their 20s and 30s. So here's a passage from Morgan Housel's book that actually looks at a study that economists did trying to figure out what Americans do with their money and how they approach it. And what they found is that people's lifetime investment decisions are heavily anchored to the experiences those investors had in their own generation, especially experiences early in their adult life. So their willingness to bear risk really just depends on their personal history. And again, depending on when you're born and what decade, that's really going to influence what happened. So there's some great examples in the book that describe exactly this. So if you were born in 1970, the S&P 500 increased almost tenfold during your teens and 20s, which means, oh, you probably love the stock market. You thought it was amazing because that's an amazing return. But if you were born in 1950, the market went literally nowhere in your teens and 20s. So here's what the stock market looked like if you were born in the 70s versus the 50s here. Extremely different, right? And here this x-axis is the age between 13 and 28. So depending if you were that age during 1950 or 1970, you're going to have a completely different outlook on stocks. And not only does your outlook change, but your actual earning potential is very different too. Because of those few decades of returns, they can be very different. And it's not just the stock market, it's anything relating to the economy. So take inflation, for example. If you were born in the 1960s in America, you saw prices go up more than threefold just during your teens and 20s. So you remember gas lines and getting paychecks that didn't cover much. But if you were born in 1990, then you don't even think about inflation because it was so low. Once again, you could see the chart. This is 1990, this gray line, versus 1960, which is why you can ask a younger person about inflation right now. We don't care about it at all. You ask an older person, they're worried about it. And who is right exactly? Well, we're going to talk about that in a second. But you could look at other stats like unemployment in 2009 during the whole crisis. It was around 10%. But if you were a teenage African-American male without a high school diploma, then that unemployment rate was almost 50%. 20%. And for white females over the age 45 with a college degree, it was only 4%. So once again, it really depended where you were born and who you were born to. Very different scenarios for different groups of people during the same time even. We can look at it globally, like local stock markets during World War II. Germany and Japan were wiped out, but the US had their stock market more than double from 1941 through the end of 1945. So it was a crazy time, great returns. And the economy was the strongest it had been in almost 2 decades. So once again, very, very different experiences that are going to influence how those individual people look at markets and money. So it not only changes your mentality, but it also affects your actual earning potential. It all depends on what type of market you were born into. And I'll explain in a second why people born into this market or people who got into the market after 2008, they are in big trouble. But we'll go over that in a minute here. Another great example in this book is a Financial Times interview with Bill Gross, who is the bond king. And he fully admits he's a product of his time. So he said he probably would not be where he is today if he had been born a decade earlier or later. Gross's career coincided almost perfectly with a generational collapse in interest rates that gave bond prices a tailwind. So basically, he was trading in a bond bull market, which is why he made so much money and why he became the bond king. That kind of thing doesn't just affect the opportunities you come across, it affects what you think about those opportunities when they're presented to you. And that's the main point I'm saying. Not only the opportunities, but how you think about them. So to Bill Gross, bonds were wealth-generating machines, but to his father's generation, who grew up with and endured higher inflation, they might be seen as wealth incinerators. So again, his dad grew up during a time of inflation, so buying bonds was stupid. But for Bill, it was amazing, and he made a fortune. So what's the lesson from all of this? Is it that you should just give up because if you were born in a certain year, you don't have a chance of making money? No, that's not the lesson. There's a few here that we should take from this. The first one is that you need to stay open-minded, because what happens to a lot of us is that we think we know a lot, but in fact, we know very, very little. And that's the idea behind the name of this channel, aka Fallible. Fallibility is super important. Understanding that you don't know everything and that new information can come along that can change your opinion on things, that's very important. And being open-minded enough to change is even more important. You need to be able to imagine very different scenarios than what you have previously experienced. Just because it hasn't happened to you yet does not mean that it can't happen. So if, for example, you think there's no way that we'll ever hit high inflation ever again, well, that's a very ignorant thing to think. Just because you weren't around when there was inflation, you're too young to have experienced that, doesn't mean it can't happen again. A better example is the debate that I hear about gold being obsolete because now we have Bitcoin. That's just not true. And both parties can be very wrong. So gold bugs, people who love gold, they say Bitcoin is stupid. It's just some stupid technology. It'll never be worth anything and it doesn't replace gold at all. And then you have the Bitcoin bros, the people who think Bitcoin solves everything, and they say gold will never be used again. We don't need it. This is the new gold. Plus, it does all these other things. Again, both sides are wrong because the gold bugs, they never had an experience with this type of technology that is Bitcoin, right? And the Bitcoin bros, they never had an experience with actually needing gold and facing inflation and seeing a country collapse and all your money losing value. So the correct mentality is more along the lines of gold is valuable and Bitcoin might be valuable too. Keeping that open mind and kind of playing it as it goes, but not dismissing the possibility of something happening where people flood into gold and it becomes the most valuable asset because it has happened before. Now, I think a lesson that is even more important than that especially affects young people, like I was saying, 35 and below, is the idea of risk management. Now, if you're an older person in the market and you went through 2008 and you had your life savings in the market, you remember just how bad things can be. But if you started investing after 2008, sure, there have been some slightly turbulent times, but for the most part, you've been okay. You've been investing in a bull market, in what seems like a never-ending bull market. Now, the people who went through 2008, they understand the importance of managing risk because of what can happen. The people who are investing after that, not so much. Because nothing big actually happened to them, they think, what's the point of managing your risk and cutting your losses? Why don't you just buy and hold? And the people who have it the worst are not the ones that started right after 2008, but the ones that started after our pandemic March 2020 crash, or the ones that started during it. That massive rebound that we had in the market, I'm talking about this one right here, this crash and super quick recovery, this is going to ruin the future of so many investors, and let me explain why. Because what that did in that recovery, which does happen in the market, it's possible, it reinforced the worst habits in every investor who started during this time. Because now you got the mentality in your head that you should always buy the dip, and that diamond hands are the way to go about every investment. And the idea of risk control, it just sounds stupid. Why? Because the people who did have risk control, they ended up getting out of stocks that just rebounded. The people who didn't have any risk control, they were rewarded. And in this particular type of market that we're in, people are getting rewarded over and over again for the wrong principles. So again, you get rewarded if you don't control your risk. And this type of market, mixed with the access that everyone has now with apps like Robinhood, is creating a generation of idiots. Because yeah, you get rewarded in the short term for no risk control in this particular type of market, but long term you are absolutely going to get crushed by a bus. And it is very hard for younger investors to believe that, because again, they never had to go through anything. Morgan talks about that in his book. He says the challenge for us that haven't gone through certain scenarios is that no amount of studying or open-mindedness can genuinely recreate the power of fear and uncertainty. So spreadsheets and data, it could show us what happened in history, right? But you can't model the feeling of coming home and looking at your kids and wondering if you've made a mistake that will impact their lives. Studying history makes you feel like you understand something, but until you've lived through it and personally felt its consequences, you may not understand it enough to change your behavior. We all think we know how the world works, but we've all only experienced a tiny sliver of it. So that's why on this channel, when I constantly rant about risk control, some people get mad. They're like, you're just spreading fear and doubt. And no, that's not what I'm trying to do. I'm just trying to remind everyone that, hey, there is a downside. But yes, I do understand why the younger investors don't believe it. They're going to have to experience it for themselves, and it's going to be brutal. I think Robinhood has 30 million accounts now. That's a lot of people that are going to learn a tough lesson. And we might go from this current investing generation that has had so much access to markets like never before. This is a completely different thing. We got social media and markets together. So we might go from a generation that is super gung-ho about it and really positive about it to one after a crash that absolutely despises the markets and doesn't trust stocks. Just like when we think back to those Great Depression people who never trusted banks for the rest of their lives. To us, that's like crazy, right? But what if the same thing happens here? We don't know. And that's why, once again, you got to keep an open mind. And there are some principles like risk management that you should adhere to, regardless of when you were born, because it's one of those tried and true things that is always going to work and it's going to save you. And principles like that are going to help regardless of when you were born. And we actually go over 5 of those principles in this video right here. It's called the 5 reasons you can't become a consistently profitable trader. But of course, we help you overcome those reasons too by teaching the principles that you need to know. So if you want to prepare for what might be a really bad time for investors coming up, make sure you click this video and I will see you there.